Jason Bond from the Bull Microcap Fund. The JP Morgan Guide to Markets is out, and there are several interesting slides. The S&P 500 index appears to be at an inflection point at a level of 5,762 as of September 30th, 2024. The forward PE is 21.5. Compare this to the forward PE January 3rd, 2022, which was 21.4, or the forward PE February 19th, 2020, which was 19.2, or the forward PE on October 9th, 2007, which was 15.1, and finally the forward PE on March 24th of 2000 was 25.2. The CAPE, the cyclically adjusted PE today, is 37.4, which is higher than at any time in the last 150 years except for the year 2000, which had a CAPE of over 43.21. So today the S&P 500 index appears to be in a bubble. On the other hand, perhaps AI will boost US GDP so much that it turns out not to be a bubble. The forward PE of 21.52 is 47% higher than the 30-year average of 16.73. Similarly, the CAPE, the cyclically adjusted PE, at 37.4 is 34% higher than the 30-year average of 27.9. But please note that the longer-term average CAPE is closer to 20, and so the current CAPE of 37.4 is 87% higher than this longer-term average. Also, the subsequent one-year returns for a forward PE of 21.5 is around 0%, whereas the 5-year annualized subsequent returns for a forward PE of 21.5 is close to 1 to 2%. Profit margins for the second quarter of 2024 are 12.9%, which is one of the highest levels ever. However, arguably the Magnificent Seven should have sustainably higher profit margins based on their technological innovation, including AI. On the other hand, profit margins based on EBIT, earnings before interest and taxes, haven't changed much in 75 years, which, with most of the profit margin improvements in recent decades being due to lower taxes and lower interest costs. If you compare the relative forward PE ratios of value versus growth, the long-term average is 0.71, while the current level is 0.55, which means value is cheap relative to growth. The forward PE of the top 10 stocks in the S&P 500 is currently 30.5 versus a 30-year average of 20.5. Note that the forward PE of the top 10 stocks in the S&P 500 in the year 2000 was 43. The forward PE of the remaining stocks in the S&P 500 is currently 18.4 versus a 30-year average of 15.6. It's interesting to look at the recent performance of the Magnificent Seven stocks. In 2021, the Magnificent Seven returned 40% versus only 17% for the S&P, not including the Magnificent Seven, or 27% for the S&P 500 overall. In 2022, the Magnificent Seven dropped 40% versus a drop of only 8% for the S&P, not including the Magnificent Seven. The total drop for the S&P 500 in 2022 was 19%. In 2023, the Magnificent Seven returned 76% versus only 8% for the S&P, not including the Magnificent Seven. The overall S&P 500 returns in 2023 was 24%. So far, year-to-date 2024, the Magnificent Seven have returned 35% versus 11% for the S&P 500, not including the Magnificent Seven, or 21% for the S&P 500 overall. Also, the earnings growth of the Magnificent Seven was minus 14% in 2022 versus 9% for the S&P 500, not including the Magnificent Seven. Earnings growth of the Magnificent Seven in 2023 was 31% versus minus 4% for the S&P 500, not including the Magnificent Seven. And earnings growth for the Magnificent Seven in 2024 is 34% versus 4% for the S&P 500, not including the Magnificent Seven. Moreover, the profit margins for the Magnificent Seven reached 23.5% in the second quarter of 2024 versus a profit margin of only 8.5% for the S&P 500, not including the Magnificent Seven. It's interesting to look at the current PE versus the 20-year average PE for different segments of the market, but in particular growth. For large growth, the 20-year average PE is 19.2, whereas the current PE is 28.5. For mid-cap growth, the 20-year average is 20.7, whereas the current PE is 27.2. And for small growth, the 20-year average is 25.5, whereas the current PE is 41.5%. So in percentage terms, large growth is 148.9% higher in terms of PE than its 20-year average. Mid-cap growth is 131% higher than the 20-year average, and small cap growth is 162.7% higher in terms of current PE versus 20-year average PE. The average intra-year decline for the S&P 500 index has been 14.2%. Despite that, annual returns have been positive for 33 out of the past 44 years. There are 6 recession determinants used by Niebuhr: real personal income less transfers, non-farm payroll employment, household survey employment, real consumer spending, real wholesale plus retail sales, and industrial production. All 6 of these recession determinants are in positive territory. Consumer balance sheets are in good shape with total assets of $184.5 trillion versus total liabilities of $20.7 trillion. The household debt service ratio is around 10%, which is near the bottom of its 44-year average range. The personal savings rate is 5.2% so far in 2024 versus a 64-year average of 8.5%. If you look at all the major AI hyperscalers, Alphabet, Amazon, Meta, Microsoft, Oracle, CapEx has been significantly increasing and is forecast to continue significantly increasing. CapEx from the major AI hyperscalers was $123 billion in 2022, $126 billion in 2023, and is forecast to be $192 billion in 2024, $218 billion in 2025, and $237 billion in 2026. The federal budget is not in good shape. The current federal deficit is $1.92 trillion and is currently forecast to stay level or to continue increasing if the Tax Cuts and Jobs Act of 2017 is extended. Federal debt is at 97.7% of GDP and is forecast to increase to 120.8% of GDP in 2034. If the Tax Cuts and Jobs Act of 2017 is extended, then the federal debt is forecast to increase to 131.8% of GDP in 2034. Since 1973, civilian unemployment has averaged 6.2% annually, while wage growth has averaged 3.9% annually. Essentially, wage growth has barely kept up with inflation, which is unique to the United States versus most other industrialized nations, which have seen much greater wage growth. Since 1973, inflation has averaged 3.7% annually. The Fed reduced interest rates from 6.4% in the year 2000 to 1.6% in 2001 and then below 1% in 2002. These cuts did not prevent the S&P 500 index from declining 50% from 2000 to 2002. The Fed reduced interest rates from 5.1% in 2007 to 0% in 2008, which also didn't prevent a 50% plus decline in the S&P 500 from 2007 to early 2009. The Fed is now reducing interest rates again. If there's going to be another 40 to 50% decline in the S&P 500 index in the next few years, the Fed cutting rates won't prevent it. The balance sheet of the Federal Reserve is now around $7 trillion and is forecast to stay around that level over the next few years. From 1958 to present, nominal yields for the 10-year Treasury have averaged 5.74%, while inflation has averaged 3.81%. This means the real yield has averaged 1.93% from 1958 to present. As of September 30th, 2024, the nominal yield for the 10-year Treasury is at 3.81%, while inflation is 3.27%. So the real yield is 0.54%. In terms of international valuations, the MSCI All Country World ex-US Index has a forward PE of 13.8, which is a 36% discount to the S&P 500 Index, which has a forward PE of 21.5. In terms of specific countries, the United States has a forward PE of 21.5, Japan has a forward PE of 14.7, Europe ex-UK has a forward PE of 14.5, emerging markets have a forward PE of 12.7, and China has a forward PE of 10.5.